Professor, you on mute. Professor, maybe you quit and you rejoin.
You hear me now? It's okay now?
Yes, good now.
Oh, okay. Sorry. A small technical problem. All right. So let me also turn on my camera. Okay. I recorded already. Okay. I didn't know. I'm going to share my screen. Everything should be all right now. Okay. So everybody can see my slide? Yes?
Yep.
Okay, perfect. So let's come back. Let's restart it again. So we are interested about how to estimate cost of capital. The cost of capital estimation of cost of capital for firm is super important. Why? Because when you do valuation of firm, you want to, acquire a new company, or you want to do valuation of a company. So we need to have a discount rate to use to make the valuation. So now how are we gonna estimate the firm cost of capital? Ideally, we are interested to look at what is the asset risk. Okay, on the left hand side, what is the business risk of the company you are going to evaluate on the left hand side? But it's complicated to evaluate each item of the risky asset on the left hand side, right? Either current asset, long-term asset. So we can also look at the right hand side, okay, because capital market can evaluate the risk that they take, okay, and price it on the instrument in the market, right? So the company can finance the from the right hand side of the left hand side, okay? So if Okay, you have the level of debt. Okay, and then you have also the level of equity. You borrow from someone, you issue debt. When you ask someone to own the company, okay, part of the ownership of the company, you issue equity. Okay, the blend of the debt and equity, the structure where the source of capital have been used by the corporation, okay, we called it as the capital structure, right? These capital structures, if we know that the cost of debt, the cost of preferred stock, the cost of equity stock, we can calculate weighted average cost of capital, and we call it as the, WACC, or or cost of capital, weighted average cost of capital on the right hand side. We use it as a proxy of the firm cost of capital. Okay, you understand a little bit about the idea why we need to estimate cost of capital and so on and so forth. Okay, so therefore, weighted average cost of capital on this exercise represent the firm risk, right? Represent required rate of return to the overall capital provider of the company, okay, that finance, that evaluate the risk of the asset of the left hand side. Okay, so therefore on the first class, I remember someone answer me whether when you are going to evaluate the project, okay, how we gonna discount, or what we're gonna use the IRR to compare with the R of the project. And I said that is not the R of the work. Okay, why our project and our work can be different? Because our work represent weighted average cost of capital, which is the average or the overall risk asset, right? The riskiness of the assets. However, if you have a new project, for example, when you are going to do another new project, and the new project can have a different risk profile of the company risk. So therefore, sometime if you use the work to discount your project, or as a project cost of capital, can be faulty, can be bad, right? Because the project risk can be completely different, can be also similar in some cases. So therefore, it depends. Okay, but I just want to ensure that you understand the concept operating cost of capital. Okay, now when we're talking about all these, okay, we are interested in calculating, all right, the weighted average cost of capital. When company has D, which means has debt, we call this kind of firm as the levered firm, or firm that has that use the debt in their financing. Okay, and then obviously you're gonna calculate the weighted average by using the fraction of the firm value financed by equity multiplied by equity cost of capital, fraction of firm financed by debt multiplied by debt of cost of capital, and then you get asset cost of capital. And this asset cost of capital, you use your calculation RWAC as a proxy of the asset cost of capital. Everybody understand what the proxy means, right? So we use it as an estimate of the asset cost of capital, okay, as a proxy. So yesterday we finished, okay, or we introduced you how we estimate the fraction of firm value financed by equity, or fraction of firm value financed by debt. Okay, this one is we call the leverage. And this leverage, I told you yesterday, you can calculate it, leverage in terms of total value, in terms of total asset, in terms of equity. So everything should go, in the same direction. But in this formula, we use the debt over total value. Okay, mean equity plus debt, and all these number we are talking about here. We are interested in the market value of assets, market value of debt, and market value of equity. Okay. And then we stop or we introduce you how to calculate the RD. The RD is the cost of debt. The cost of debt, we do two ways to calculate the cost of debt. As I told you, the cost of debt here is not the not necessarily the coupon rate. The coupon rate is just only the 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 rate that the investor, the bond investor, will receive the cash flows, right? Nothing to say about the nothing to say about the cost of debt. Okay, the coupon rate is not the cost of debt. Why? Somebody told me. Why the coupon rate is not necessary? The coupon rate is not the cost of debt. Right? The coupon rate, we use the coupon rate to identify, to calculate the coupons that represent the cash flow given to the investor. Okay, but it's not represent rate of return to the bond investors. Right? Because bonds are traded in the capital market. Bond can be traded at discount. Bond can be traded at premium. So the return to the bond investors, okay, is represent the something called the yield. Right? The yield or the yield to maturity represent the internal rate of return to the investor to hold the bond until maturity. All right, that is we call the yield to maturity. Right? If you take the discount rate that make the value of the bond equal to the bond price, and this one we call yield to maturity. We can use the yield to maturity, okay, as a proxy of cost of debt if bond have lower default rate. You can estimate like that, right? If you have lower default rate or the yield to maturity or required rate of return can coincide. Okay, so if there is a little risk that the firm will default, the yield to maturity is a reasonable estimate of investor expected rate of return. But if there is a significant risk of default, the yield to maturity based on the promised payments of all coupon and face value at maturity may overestimate the investor expected return. All right. So as I told you earlier, the cost of debt, the definition of cost of debt, okay, represent what? Represent what is the interest rate or return you can provide to the the investor at the time you're gonna refinance your existing debt. Okay, so it's not necessarily reflect to the interest rate the firm had to offer at the time of the debt was issued in the old days. Okay, so obviously when you do kind of bank loans, and if the bank loans your banks ask you to pay the 5% or 10% of interest. Okay, since the bank loan is not marketable in general, except in the advanced country, even loans you can you can trade the default risk in the CDS market. But in general, the bank loan interest rate you can also assume to be the firm cost of debt, which is not necessarily accurate, but sometimes we use as a proxy since we don't know how to, price the market value of your loan, the bank loan. However, if it's a bond is marketable, it is easy to observe it. Okay, so and yesterday I introduced you to one adjustment, okay, that if there is significant risk of default, you adjust yield to maturity, okay, to estimate your cost of debt. Okay, so basically what we learned is from this slide. So the RD, the expected return of the bond, is equal to Y minus the PL. Y is the yield, P is the probability of default, L is the expected loss rate, okay, of your $1. In case of default, what your value gone or disappear, okay, because your money back that you can get from the company in case of default, okay, should be less than what the face value of your debt. Okay, as you can see here, RD equal to Y minus PL. Actually, it also represent the the statement where we just say that when is little risk of default, the probability here is close to zero. So therefore, we can use yield to to estimate cost of debt of firm. And yesterday we introduced you some of the way we can observe this one. It seems like we have a question number 8. Why don't we just make this exercise together? Okay, in mid 2009, okay, also during the crisis period, no, not the crisis, recession, Rich 8 has triple C rated 6-year bond outstanding with a yield to maturity of 17.3%. Okay, 17.3% should not be used as the estimate cost of debt because the company bonds are, have, triple C rated that have high probability of default. At the time, similar maturity treasury has a yield of 3%. It means RF equal to 3%. Suppose the market risk premium is 5%. It means ERM minus RF equal to 5%. Okay, meaning that the market expected return is 8%. And you believe that rate H bond have a beta of 0.31. Okay, if the expected loss rate of this bond in the event of default is 60%, what annual probability of default would be consistent with the yield to maturity of these bond? Okay, the expected loss rate of this is 60%. So the very simple and straightforward, you can apply, okay, the yield to maturity. So if you calculate the RD, you remember yesterday I introduced you 2 ways to do so. One, you estimate by using the equation RD equal to Y minus PL, or another, we borrow the CAPM formula to estimate cost of debt. Okay, so in this case, so since you have the you can estimate cost of debt using the CAPM, since you know the beta, right? So therefore, I take RF plus beta multiplied by the market risk premium. So I know that the RD equal to 4.55% should be equal to Y minus PL because they asked this one. So therefore, 4.55% equal to 17.3% minus P multiplied by 60%. So I'm gonna have the P equal to 21.25%. 21.25% represent the probability of default of the triple C rated bond. Okay. So any question on the problem set? Question number 8. Is this clear? Perfect. Okay. So Trung Han Trang, okay, 7.265. I don't know what is 7.65 come from. 4.55. Okay, so I think the second part. Okay, perfect. Okay, now is all right. So you have the 21.25. Okay, and then yesterday we also learned on how to estimate cost of equity. Once you have the estimate cost of equity, you should be able to calculate weighted cost of capital. Okay, so in case that we have the preferred stock, remember preferred stock, the preferred stock holder. Okay, when you buy the preferred stock holder, you buy preferred stock, you become a preferred stockholder, you expect to get fixed dividend forever. So therefore, you can make the valuation or valuing this preferred stock, the P would be equal to dividend divided by R. If you want to know the R, okay, the R of the preferred stock capital should be equal to the dividend of the preferred stock divided by the P. Assume that the class A preferred stock has a price of 66.67, annual dividend is 3.5. Okay, it's constant by definition of the preferred stock. Therefore, the cost of preferred stock, you can just simply apply these perpetuity formula, and then you're gonna get 5.25%. Okay, the last one that we discussed yesterday is about how to estimate companies' cost of common stock, okay, or cost of the common shares. So we can use the CAPM. Okay, the CAPM is a capital asset pricing model that people can use to estimate cost of equity capital. Okay, so meaning that you can use the CAPM formula where the ERI that you use it as a proxy of the RE. All right, so it should be equal. Okay, so okay, I have a question. Can you explain when we use average and when we use in recession? So so basically this one, there is no explanation. We just know that in the US, in that particular period, there was a kind of economic recession. Okay, so we don't know how we gonna divide it, but we know that during the normal period when the economy goes normally, and you have some statistics when you have the recession period where the situation of the bond market increase the default rate, so therefore we're going to use recession. So it's only divided by year, where people know that this period is a recession period. Okay, so there is no definition to use it. Okay, is this okay, Tran? All right. So for example, in 2000, 2001, they have a dot-com crisis. So the economy went badly, and that one also another period of recessions. Okay. I would think that during pandemic, some period, the economy was, very bad. And therefore we can consider that some period where some economists define that this is a recession period in the US. In that case, you can assume using the data during the recession as example, or proxy. You see what the meaning of the proxy, that okay, the likelihood, the probability of default, which number you should apply when you estimate cost of debt. Okay, it's at the end of the day, it's gonna be your judgment based on economic data, based on the information that you can get it from capital market, to use to apply which number, which situation you should apply. So how to estimate cost of equity? So you first of all, you estimate the firm beta of equity by regressing 60 months of the company return example. This is example. Some people, if you take the firm beta of equity of some of the big firms, sometimes you have some data providers such as Bloomberg, Reuters, they calculate already for you. But interestingly, that sometimes they have different number on the beta because it depends on how they estimate which period they use to estimate, what the market proxy they use. Okay, usually the market proxy is the S&P 500 for the US firm, and then they use the historical data. The longer the better, that make the regression works better. Okay, and then you determine the risk-free rate. Usually when you use the equity valuation, which is relatively, normally you have no maturity for equity, right? So therefore, if you want to use the risk-free rate, we typically use the yield on the treasury bills long term. Estimate the market risk premium. This also come from the historical return, and then you apply the CAPM. Have you ever done kind of estimate the beta of equity by yourself? If you are going to invest in, or interesting to know whether what is the beta of Vinamilk, you know how to estimate the beta. Have you ever done any beta estimation? Obviously, yesterday someone also asked me whether the CAPM should apply in the real world. Okay. I would say that even the CAPM may be not the best model to estimate cost of equity capital. However, CAPM still useful because you can use for the comparison and make the relative term to understand something. Okay, if you want to calculate, for example, cost of equity capital of one Vietnamese bank compared to cost of capital of cost of equity capital of the Vinamilk or construction company, and so on and so forth, you can still compare and to see the level of risk. I remember some of my students of CFVG have been estimated, and the beta of those companies seems to also consistent with the advanced country, the capital markets. Okay, so if you don't know how to estimate beta, they're very straightforward. I can probably ask you to do so as a homework. Very good. Are you interested in? So just only for fun. So what you have to do is, I have the slide on the beta estimation. So basically, beta is the expected percentage change in the excess return of security for a 1% change in excess return of the market portfolio. Okay, for example, if I use the historical data of Cisco stock, okay, so you're gonna get kind of daily return or monthly return over the period. You need two series of data, the data of Cisco stock and the data of S&P 500. Okay, once you have these, it's very straightforward. You can plot the graph where you use S&P excess return. You understand what the excess return mean, right? ERM minus RF, and then you have the RI minus RF. You're gonna have you can plot these kind of linear line where you're gonna get the slope of this line, and the slope of this line should represent the beta, which is the base fitting line that represent the market risk. Okay, so basically this, you take the equation of the RI, okay, equal to the RF, okay, plus beta RERM minus RF, right? Everybody follow me? So the CAPM formula, okay, which is ERI equal to the RF plus beta ERM minus RF. Okay, that is the CMPM formula. If I take the RF of the ERI minus RF, should be equal to the beta of the ERM minus RF. Okay, so I have y equal to the beta of x plus some error term. When I calculate, when I compute, I make a regression. Everybody know how to make regression, right? This is a linear regressions, okay, where you put y axis on the ERF, ERI minus RF, and ERM minus RF, and the beta should represent the slope of these regressions. Okay. Oops. Okay, which is exactly with this one, right? The ERM or RM minus RF, RI minus RF, you plot the graph and you get the beta. Okay, you can have Excel spreadsheet and you can just take the series of return. For example, you take a monthly excess return of of S&P 500 and Amazon. You're gonna be able to calculate the beta of Amazon. Okay. All right. It's okay. Have you ever done it? What I suggest you, do you have the stock price data on the return data? You know how to calculate the return, right? If you have some data provider in the capital market in Vietnam, what is the market portfolio, the proxy of market portfolio in Vietnam that you can use? You have different market. Do you have the market index of the overall Vietnamese capital market? No. What is the market index? What is the market portfolio in Vietnam? VN index. Perfect. So if you use the VN index, can you make a try, and tomorrow or the day after tomorrow, if someone can help me, I give you a bonus point. So you can take some of the major stock. Okay, so let me see whether I have any. Okay, you can take one, pick up one of the stocks in Vietnam, in different industry, you estimate 2 beta of stocks. You run regression, do something simple in Excel spreadsheet. You have a series of returns, okay? And then you take the return minus RF. You can estimate any RF you wish because it go to both sides. It should be fine. And then you estimate the beta of the company that you are interested in. And tomorrow you share with me what is the beta of which company in which sector you obtain. Okay, so each one can have different, stock picking, and then we're gonna see whether the beta seems to go well when you are in risky business, when you are in, lower risk business, whether the market risk estimated by CAPM works or not. Okay, to just simply challenge us and just for fun, and then we can discuss it tomorrow. It's okay. Why don't we try that? You know how to? Do you know how to do it now? Perfect. Okay, just for fun, how to estimate the beta. Okay. So let's come back to our business. Once you know the beta, you know all this, okay, assume that the equity beta, okay, you see that they're precise, right? You can have the asset beta, you can have debt beta, you can have equity beta. But in general, the one that we're talking about when we observe in the equity beta, okay, is represent the equity beta, right? Because it's a stock. The common stock is an equity. Okay, so we discuss later on because sometimes people use the equity beta with the asset beta and so on. Okay, so assume the equity beta of DuPont is 1.37. The yield on 10-year treasury notes, treasury bills is 3%. The market risk premium is 6%. So therefore, cost of equity capital is 11.22%. Okay. Alternatively, if you don't use the CAPM, we can also use, the fundamental constant dividend growth model, okay, where you have the, the price of stock should be equal to the dividend one divided by I minus G, right? R minus G. And if you want to get the R, you rearrange it. The R should be equal to dividend divided by the P plus G. Dividend divided by the P, we call the dividend yield. Okay, expected dividend yield because you use the year one. Why we use the year one? Because the formula, right? The formula where you apply your high school mathematics to get the calculate the dividend with growth. Okay, the dividend, you assume that the dividend one started at the year one and then is grow at the constant rate of G. So therefore, you can use the perpetuity with growth as the formula to calculate the price of the stock, and then we get that price of the stock to rearrange it, and then you should be able to calculate cost of equity capital using this Gordon-Chapro model. Okay, so as you can see here, if I give all those information, I have long run earning growth rate can it be estimated by you, by investor, by analysts, equity analysts, and so on and so forth. And you have the assume that the earning growth rate was 6.2% and the dividend payout keep remain the same. So therefore, the G, which is the growth on the dividend, can be estimated at the 6.2%, and dividend is 1.64. Okay, and divided by 36.99, and then I get 10.6% the cost of equity. When I use the CAPM, I get 11.22. So therefore, the estimates of cost of equity capital can be ranged from 10.6 to 11.22. As you can see here, the proxy, right? It's complicated to get a precise answer in the real world. So, but we can use different model to see the different possible number, so that when you do valuation, you can make some scenario analysis. If I use 10.6, how the value go? If I use 11.22, how the value goes? And then you make your final decision when you negotiate the price for merger and acquisition deal, and so on and so forth. Okay. So since each method has pros and cons, when you do the CAPM, you need to estimate equity beta. Okay, remember the equity beta can be only accurate if stocks are liquid, meaning that they trade when the price of the stock are quite representative of their fundamental value. It's very difficult if you estimate the beta of the stock that are not not liquid or not traded. So therefore, you may have some errors or some a problem in those kind of beta estimation. So therefore, you should not apply the CAPM in that particular case. You can use the constant dividend growth model, where you can estimate the future dividend growth rate by your own, and then you make your own estimation not based on equity beta, right? So there are several possibility, but when you do valuation of top investment bank, when you do valuation of firm, to do IPO, to do some of those, usually we use also the CAPM. The CAPM still more use more than the constant dividend growth model, but people can estimate both. And we have seen that already. The equity beta of Johnson & Johnson is 0.67, okay, which is makes sense. Okay, most of the pharmaceutical company has a lower market risk. If the yield of the 10-year treasury is 3%, you estimate market risk premium to be 6%. So market risk premium historically, okay, this around 6 or 7%. Okay, in general. Further, Johnson & Johnson issued dividend at an annual rate of 2.16. Its current stock price is 60.5. You expect dividend to increase at a constant rate of 4%. Estimate JJ, cost of equity capital two ways. So it's very straightforward. You use the risk-free rate of 3%, equity beta of 0.67, market risk premium of 6%. On another side, you estimate, or you don't estimate, you observe that current price of the stock is 60.5, expect dividend is 2.16, and the future dividend growth rate is 4%. If I estimate both methods, the first with the CAPM, I get 7. When I use the constant dividend growth model, I get 7.6%. Okay, so you can assume, okay, that if you use these two as a proxy, that the cost of equity capital can be ranged from 7 to 7.6%, and then you use some scenario analysis to make your valuation using different numbers. All right, so that is how we estimate it. Let's take another look on the WACC. The RWAC that we used earlier represent the RWAC or the WAC of what? Of the firm in the perfect capital market. It means you have no market friction. And one of the market friction very real is about the tax. Okay, so we know that the advantage to use debt is that the interest that you pay on the debt is tax deductible. Tax deductible, it means that you can save costs, okay, on your cost of capital of a firm. Okay, and the reduction of your cost of capital due to the interest deductible on your corporate tax, we call the interest tax shield. So if I come back to my formula and I use the effective cost of debt, okay, RD equal to the RD multiplied by 1 minus tax rate. If I rearrange it, I can see that the RWAC actually can have the pre-tax WAC minus reduction due to interest tax shield. And the reduction due to interest tax shield would be equal to the D over D plus E multiplied by the RD multiplied by the corporate tax rate. Okay? All right. So, for example, if this is how we put it back, all these together, if the market value of DuPont common stock, preferred stock, debt were 30,860, this is the example where we combine everything together to calculate the WACC. Okay, so if the RD is 3.66%, R preferred stock is 5.25%, RE using the CAPM is 11.22%. This is come from the previous exercise. You can be able to calculate the RWAC of the firms, okay, which is go to 9.11%. 9.11% is the company's cost of capital. You use the WACC estimation as an estimate of company or firm's cost of capital. All right. So, okay, this one is another example we have already seen. Okay, I don't need to just only another example. You can have a look by yourself. So the WACC for real company, and you can see here, this is come from the textbook. Okay, so what do you see? Can you help me to observe? I'd like you to observe, don't calculate anything. When you have NA, is mean not applicable, because, for example, Apple and Research in Motion, they are usually they finance 100% by equity. Okay, so in real life, when we're talking about cost of debt here, when we're talking about the D, we often refer only the interest-bearing debt. Okay, we don't use the, for example, we use only the short-term debt and long-term debt, or the current portion of long-term debt. Okay, to estimate the total value of debt. Okay, we don't use the how we call working capital debt, right? Sometimes you can have some working capital debt in your balance sheet that is part of your current liability. We don't use it on estimating cost of debt. Cost of debt is only the proportion on the real debt financing. As you can see here, right, the company like Hershey Company, ExxonMobil, the Johnson & Johnson, Airlines, and the high-tech firm, retail like Starbucks as a high beta. What is that first company? Hershey Company, what does they do? Somebody knows? They have only 0.28. No? Somebody asked me what's the AMD. Somebody know the AMD? Oops, sorry, is it AMD? Do you have computer? What they do, the AMD, somebody know? Have you bought your new computer recently, when you go to the computer shop, sometimes they give you whether is Intel or is a AMD. Okay, is a they do basically the processor. It's like Intel, right? It's a competitor of Intel, and then they provide the computer CPU, for example. Oh, it's the same as Intel. No, it's not the same, but it's a competitor of the Intel business. Okay, so what is the first one? The first company that has very low beta. What they do? Have you ever been to the supermarket and then you have, for example, some chocolates, right? So they sell chocolate and some other, you know, snack food and some of other things. So these obviously seems like the chocolate business should be less sensitive or more sensitive to the economy. No, it should be. It should be when the economy goes badly, you eat chocolate. When the economy go well, you can eat chocolate too. So the sensitivity of the chocolate business should depends less on the market risk, okay, compared to the high-tech firm and so on and so forth, right? So at the same for beer stocks. Do you have beer stocks in Vietnam? They're all listed or non-listed? No? What is the name of the beer in, is it Saigon beer? You have how we call that one? They have Saigon beer. Is it a listed company? The company who produced Saigon beer is a listed company. Sabeco, okay. Anyone, one of you, would you mind make the beta, calculate the beta of Sabeco compared to, one of, I don't know what the name of the real estate company, the big Russian, highly politically connected, Vinhome, for example, very good. Can you just make a simple beta estimate to see whether, or you can use also banks, some of those kind of high profile company where these are big stocks, they are traded regularly. You can choose some of these and try to get some idea to see whether the capital market price it in the way that we learn in the theory, okay? Whether it consistent or not, okay? Just make fun on those estimation, the curiosity, some of the pick up of stocks to calculate the beta. All right, very good. So again, some of the refinement of the calculation when we're talking about the debt, the D that we use in the calculation, please ensure, remember all the estimation we use the market values. Okay, that's the first thing. When we use the debt, usually we use net debt. Okay, for why? Because some company, they are cash risk company. When you have cash risk company, the position of the total debt may not reflect to the real debt obligations. So if you take the debt, so therefore when you calculate, you should use the net debt. That is mean debt minus cash and risk-free securities, okay, or we call near cash, right? So and to estimate it, right? So the enterprise value can be also used as the proxy of D plus E, right? Okay, this is another example on how we can apply and estimate it in practices. Okay, method in practices. For example, I think yesterday someone also asked me how we estimate how we gonna use the risk-free interest rate. The risk-free rate we use most firm when we use the yield on the long-term treasury bonds. Okay, if you do valuation of Vietnamese firms, you can use long-term Vietnamese government bond yield as the proxy of the risk-free interest rate. Okay, so the market risk premium is also, the excess return, usually, reducing over time. If you use more recent data, the market risk premium, can goes down. Okay, and so on. So just want to give you some idea. Okay, that is come from the textbook that want to remind you. Okay, so you see that in real life, the estimation can be different. You can use different proxy. Therefore, it's so important for you to understand the concept. The first question that you should ask is, what assumption you use, what's assumption that Goldman Sachs use to do valuation of firm. Okay, so in real life, no one can give only one number. Okay, what you have to check to understand, first of all, how they estimate it, and then you do whether the estimation they use, the estimation you use is overestimate or underestimate, and then you can try to make a different scenario with different numbers so that you can, make a range of value that you can obtain based on different assumptions. That is how the way it works. All right. So this chapter is very straightforward and very practical, okay, on how to estimate cost of capital. In the exam, I'm gonna give all these, simple calculation, and you should be able to estimate firms' cost of capital. Remember why we need to, how we're gonna use the firm cost of capital. Firm cost of capital, we use this as a proxy of cost of assets, right? Cost of asset, it means the risk, overall risk of a company. Okay, so therefore the project cost of capital is not, all right, is not equal to firm cost of capital. However, for example, if you do a new project of Intel, okay, since we just talk about Intel, they do only one business, which is about the chips, okay, CPU they provide. They never diversify to many other industries, so they are very straightforward. Let's assume that Intel is going to invest in the new project in Minnesota, okay? So to be able, in that case, you can use that the new project of Intel, okay, cost of capital is, you can use the firm cost of capital of Intel as a proxy of project cost of capital. That is fine. Just take it about the Vingroup, right? Can you use the Win Homes beta to estimate the new business of Win Retail? The answer would be no, right? Because the retail business, when you do some convenience store, can be completely different from the real estate business. So therefore, the firm's cost of capital of Vinhomes can be completely biased, when you use to estimate cost of capital of Vin Retails, right? Vice versa for any other. So therefore, the project cost of capital and firm's cost of capital can be completely different. What is the major assumption you make when you use the company weighted average cost of capital as a discount rate for evaluating the project? That's exactly what I'm talking about. So if you use, it means that first you assume that the market risk of the project is equivalent to the average market risk of the firm's investment. Thinking about a firm, thinking about the company, what is the company? The company is the accumulated of several projects the company have been invested in the past. So therefore, when you look at the firm cost of capital, you estimate the average market risk of the firm investments in the past up to now. Make sense? So if you are going to use that estimation for a new project, it means that you average in that the market risk of the project is equivalent to the average market risk of the firm investment. Can you assume this? It depends, right? It depends what the project I'm talking about and the example I just gave to you. You also assume that the firm adjusts its leverage continuously to maintain a constant ratio of market value of debt to the market value of equity. It means like you assume also the capital structure does not change when you are going to do those projects, right? So because remember we calculate the WACC based on that particular moment of the capital structure. We also assume that the main effect of leverage on valuation follow from interest tax deduction and that any other factors such as possible financial distress are not significant at the level of debt chosen. So it means like there is no other side effects from for on the leverage. Okay, we can learn that later on that what is the when the firm increase the level of debt from having the new project, okay, the cost of debt may also increase because it's increased the probability of default of your debt. Okay, all right. This is a kind of core discussion on the estimate cost of capital. You can see here the calculation is very straightforward, but understanding how to apply the concept that we learned in real life is very important. So do you have any questions? Since you are from practical world, you may have some question you want to ask me before I go to the very new exciting a chapter which is the theory of capital structure. Any questions? Yes, no, no, yes, no. Don't have, may have one question. To give me a favor. Do you have any question? One question. Anyone can ask me a question live with using microphone. Can you tell more about lever and unlevered firm? I see there is a concept of lever, unlevered firm. Is it related to the above topic? So the lever firms is the firm with debt. Unlevered firm is a firm without debt. For example, Apple, we're just talking about, okay, since the unlevered firms, you have no debt, so the firm cost of capital will be automatically equal to equity cost of capital because you have only equity, isn't it? Okay. All right. So lever and unlevered firm, we're going to do exactly in our next session on the theory of capital structure. Okay. So try to understand Martin Miller propositions that explain that no matter you have debt or no debt, the firm cost of capital should not change. Okay. Why don't include short-term loan? Why don't include short-term loan in WACC? Okay, so when I say that we use the total net debt in your estimation, it means that we can take short-term loan or short-term debt plus long-term debt. I'm just talking about short-term debt and long-term debt. But what I say that we should not, or we usually don't include another type of debt, which is called working capital debt. Right? Some working capital debt, or some of, for example, account payable, some of those other liability, because they are not, normally short-term debt is W working capital debt. Yes. If I would say that, for example, some, okay, I think the appropriate term, it should be, we should not, or we should not, we exclude short-term liability. Maybe this is a better term. Okay, so you can include, sometimes you don't include, sometimes you include, because some of, if the regular short-term loan you refinance and you regularly refinance it, almost like a permanent debt, and that one you can include. All right, but usually when we learn about the capital structure, we are interested in a kind of long-term debt financing or permanent debt financing. Whereas the short-term or working capital, it can change over time. Sometimes you have, sometimes you don't have. Okay. Usually, sometimes you also, when you use net debt, the cash the company hold often offset on some of those short-term debt for working capital. Okay, that is how usually the company manage it. So when you use net debt, the question of exclude or not exclude usually naturally solved. Okay. Is it okay? T Chudong Guyen, net debt should net of short-term investment, current asset divided by cash or cash equivalent also? Yes, yes. So therefore, the cash I'm talking about, we also call cash plus near cash, right? Near cash are the marketable security. Okay, or the cash equivalent, FUH, right? Which is also, I show here, where is that? Yeah, the cash and risk-free security or marketable securities. Okay, where the corporation, they can hold the T-bill in their balance sheet, and that is should be part of the marketable securities or the cash equivalent. Okay, but don't take inventory, account receivable, some of those are working capital. The working capital, we don't include it in these like kind of cost of capital estimation. That makes sense? Yes? Any other questions? No? Okay, so we're gonna come back after the break to have the new module on the what is the new module? The capital structure theory. Perfect. Okay, we're gonna learn on 3 chapters in 1 chart. Chapter 14 represent capital structure in the perfect market, debt and taxes, financial distress, managerial incentive, and information. Chapter 14 to chapter 16 that we can finish probably by tomorrow. Okay. All right. So perfect. Shall we have a break? Okay. And we come back. All right. So I show you the Eiffel Tower again. Oops. Do you see Eiffel Tower? Yes. In my small windows. Okay. So see you. I'm gonna take and go down to take my croissant for my breakfast. See you. Recording. Okay. Welcome back. Do you hear me? Perfect. Okay. So let's start on the new module on capital structure theories. These modules contains 3 chapters, chapter 14, chapter 15, and chapter 16. The chapter 14 that we're going to start today, right now, is about the capital structure in a perfect market. And then we introduce some market frictions like the taxes, like managerial incentive, and asymmetric information and financial distress, and so on and so forth, which is in the chapter 15 and 16. Okay. Capital structure in a perfect market in chapter 14, and imperfect market that is close to the real life will be included in chapter 15 and 16 that we're going to discuss later. Okay, so the capital structure in a perfect market that we are going to cover is about the capital structure choices. Remember, we have some observation that Apple decided to just only finance their asset on the left-hand side with equity. They usually almost zero debt, and whereas some, American Airlines, some of the Johnson and Johnson, they decided to have their debt. They have some advantages and disadvantages. And then what we are interested in is to understand why firm make different capital structure choices. What are the reason? Can we learn something from different choices, and so on? Okay, and then we're gonna learn about capital structure in a perfect capital market by studying the 2 propositions proposed by Professor Martin Lim Miller, who got Nobel Prize on these propositions. Okay. So, and then we can just recall what we discussed earlier on how to estimate weighted or cost of capital with no taxes. Okay. So, what are the capital structure choices? When raising fund from outside investor, a firm must choose what type of security to issue and what capital structure to have. Okay, so if you have a potential positive NPV project, you are going to decide whether or not you should, increase or issue new bonds or get bank loans, or you're gonna issue new shares. Okay, the capital structure is a collection of security a firm issued to raise capital from investor. Okay, no doubt about it. On the right hand side, in the capital structure theory, we often use a proxy of capital structure in the form of, for example, debt to value ratio, right? Which is the fraction of the firm total value that correspond to that, or debt over D plus E, which is a kind of debt to value ratio. Interestingly, that we can see from this graph, okay, that the firm in different industries make different choices on their capital structure. Okay, by observing this, we can see some interesting patterns, and you can see here that the average all US firm, it means average US firms, okay, they have approximately 30 something or 38 or 40 percent of debt to value ratios. Okay, so what do you observe from here? You can also observe from here that some of those high-tech firm, internet, e-commerce, those kind of thing, they have like very small debt. Whereas the banks, wow, banks and financial services are highly leveraged firms, okay? And, and on the average manufacturing firm, they are around these ratios. The capital structure of Amazon, who has about only 2% of that, where Barnes and Noble, they also, do the same business when they sell books. Amazon started to sell books, but right now Amazon sell many other things as the e-commerce. And then we can see that the Barnes and Noble has had 67 type of 33% of debt and 67 by equity. Amazon has 98% and 2% of debt. All right, interesting that the choice that the company make, different choices on capital structure. What explain all this? Okay, what are potential theories that may explain different choices? We're gonna start by talking about capital structure in the perfect capital market. But before we go, we should define what a perfect capital market means. Okay, a perfect capital market is a market in which securities are fairly priced, no tax consequences, no transaction costs. Investment cash flow are independent of financing choices. Okay, it means your investment decision on NPV should not depend on financing choices, how you're going to finance that project. No tax consequences. So the more you have debt, the tax, the interest you pay on the debt is non-taxable. Okay, non-tax deductible. No transaction cost mean there is no bid and ask spread. The lending rate and borrowing rate is the same rate. Okay, and there is a kind of market efficiency where security are fairly priced. Okay, this is a definition of a perfect capital market. Okay, so to give you, to illustrate it, I always, and that what I like also in the Bird and the Muscle, they give you a kind of simple example to give you some idea that you can observe and understand it. Let's assume, okay, you are going to have a new business. You are an entrepreneur. You are an entrepreneur where you have a project, okay, where you have investment opportunity. Okay, your investment opportunity need initial investment of 800 this year. Okay, a project will generate cash flows next year with two probability. If the economy goes well, strong economy, your project will generate the cash flow of 1,400. If the economy is weak, your project will generate the cash flow of 900. With the 1,400 with 50% probability, $900 with 50% probability. Let's assume that they are, equally weighted of these two possibility. Okay, so if you know the cash flow with probability, you're gonna be able to calculate something called expected cash flows. Right, these expected cash flows is this everyday life when you do valuation of firm, when you do estimated your expect dividend, when you do equity evaluation, you need to get those kind of this kind of concept. The expected cash flow for this project is 1,150 in the year one. Right? So you invest 800 at the year zero. Can you calculate the NPV? The NPV should be equal to the 800 plus 1,100 divided by 1 plus R, because 1,150 is the year one. Let's assume that the project has the project cost of capital of 15%. Where 15% come from? They come from that this assumption that investor require a risk premium on the project. The project risk premium is 10% over the current risk-free interest rate of 5%. So therefore, the project's cost of capital is estimated at 15%. If I have 1,150 divided by 1 plus R, I gonna get the present value of my expected cash flows. Okay, so therefore, if I want to calculate the NPV is positive of $200 value creation, right? So my question that I would like to ask you, what is the market value of this company? The market value of this company. What is the market value of this company after this calculation? The NPV 200, you invest 800, the project generate additional value of 200. So therefore, the total or the market value of the project is equal to what? What is the market value of the project? So you invest 800, you're gonna have it as a book value in your balance sheet, right? But what I want to know is what is the market value of the projects or the company if the company has only this project? The market value of the project should be expected cash flow and discount by the cost of capital. How much that we have already calculated? It should be, what is the market if you are going to sell this project to the market? Okay, how much investor will be willing to pay on your project? Obviously, it's gonna be 1,000. Okay, it should be the market value of this project because in your investment of 800, you have additional value creation of 200 that is come from the NPV. So therefore, the total market value of the project becomes 1,000. Everybody follows? You follows? The market value of the project is not 800, right? 800 is your investment. That is, we recorded in the book value. This project has additional value added from the positive NPV of 200. Therefore, the market value of the project becomes 1,000. Is this clear? Is this clear to you guys? Okay. Now when I calculate NPV, as you can see, I don't care how I gonna finance it, right? So I calculated my NPV, I have my expected cash flows. Everybody know now what is the expected cash flow, right? Expected cash flow here, we have already taken into account of the uncertainty of the cash flows, right? In this case, they have 1,400 value if the economy goes well. 900 if economy goes badly. All right. So if let's assume now we're gonna introduce the capital structure in this project, right? At the moment, the project, if the project is financed using equity alone, how much would investor be willing to pay for the firm shares? In the absence of arbitrage, okay, the market value of firm equity today would be the present value of equity cash flow, which is the extra cash flow divided by 1 plus R, which is equal to 1,000, right? So Now, what they ask is if the project is financed using equity alone, we have something called unlevered equity. It means firm has only equity. Your initial value is 1,000. In the day one, the strong economy, the cash flow you're gonna get is 1,400. The cash flow in the weak economy is 900. If I want to calculate the return on this, I gonna get 40%. This come from 1,400 divided by 1,000 minus 1. And minus 10%, which is 900 divided by 1,000 minus 1, I get minus 10%. I have two possible returns, 40% when the economy is strong, minus 10% when the economy is weak. So if I calculate the expected return on my unlevered equity, I define the U as an unlevered equity. Okay, so the RU, the expected return on unlevered equity, RU should be equal to 50% multiplied by 40% plus 50% multiplied by minus 10%. I have expected return of 15%, which is the same as the project cost of capital of 15%. So far, so good? So far, so good? Perfect. Now we're gonna start to introduce that if firm does not finance the capital structure with only equity, meaning that they are going to, introduce debt in the company. How that happen? Do equity holder, okay, who hold the risk by putting equity in levered firm. So I can have levered equity holder who gonna be able to, request the return that correspond to the risk that they take. Okay. Let's suppose the company decides to borrow $500. Because the project cash flow will always be enough to repay the debt, we can assume that the debt is risk-free. Everybody follow why I can consider that the company can borrow at the risk-free interest rate? Remember, the economy is strong. The company generate $1,400 that cover 500 plus interest rate, isn't it? Even the economy is weak, the company generate 900, meaning that the 900 should cover $500 plus interest rate. So therefore, this project or this company is risk-free. So we can assume that the company can borrow at the risk-free interest rate of 5%. Everybody follow? Okay, because 900 in case of economy is weak, therefore the 900 is always bigger than 500. The company will never default. Okay. Because the project cash flow will always be enough to repay the debt is risk-free. Therefore, the firm can borrow at the risk-free interest rate of 5%. So it will owe the debt holder of 500 multiplied by 1.05. So after 1 year, the debt holder will receive 525 that represent 500 of the principal repayment and $25 for the interest. The problem is if I write this, and can you just have this look? I have debt and I have lever equity now, right? So the principle when we do the cash flow waterfall, the balance sheet or the capital provider has have different priority on the cash flows generated by the companies. Okay, so the debt holder get the money first when you allocate the cash flows, and then after the debt, they pay the equity, right? You have to pay debt first before you go to equity, because the rule of the game that if you don't pay the debt holder will consider that you default your debt obligation. So therefore, you're gonna make the company in trouble, because the debt holder can go to the court and force the company to stop and go bankrupt and get the money to pay the debt holder, right? To the debt holder. So therefore, the debt has a priority on the cash flow waterfall. And then after you pay to the debt holder, the remaining cash flow will go to levered equity holder. Now let's take the same table that we have here. Okay, this table I have no debt, right? Now if I have debt, how I can distribute my cash flows? As you can see here, my 500 of debt that I borrow, when the economy is strong, 1,400, I'm gonna use 525 to pay to the debt holder, right? 525 come from 500 plus 25%, $25, which is 5%, which is the interest. When the economy is weak, the firm, we're gonna use the cash flow that generate with the weak economy of 900. I paid 325 to the debt holder. So I have 375 left on the cash flow. I pay to lever equity holders. The lever equity holder, when the economy is strong, 1,400 minus 525, equity holder will get 875. And what it should be the value of the levered equity then, right? If I have the firm of 1,000, the debt is 500. What it should be the value of the E? Look simple, but it's not that simple. And then Professor Martin Miller in 1958 proposed an answer to this question of what should be the value of the E. Martin Miller argued that in the perfect capital market, the total value of the firm should not depend on its capital structure. Their reasoning is that the firm total cash flow is still equal to the cash flow of the project and therefore have the same present value of 1,000. So therefore, if the value of debt is 500, the value of lever equity must be 1,000 minus 500, which is 500. Okay? MM's conclusion went against the common view which stated even with the perfect capital market, leverage would affect the firm value. If I calculate the expected cash flow exactly what I did before, it was thought that the value of lever equity would exceed 500 because the present value of its cash flow at 15% is 545. Remember, we have 875 and 375 to the lever equity holder. So lever equity value, if I calculate expected lever equity, I can have half of 875 plus half of 50% of multiplied by 375, which is here, right? I discount it with 1 plus R, I get 545. In this case, the total value of the firm should be 500 plus 545, which gonna be 1,043, which is bigger than 1,000, which is bigger than what Professor Martin Miller proposed that it should be 1,000. What's going on here? Right? So Anyone can give me the answer? What is wrong? Why the 543? You would think that the lever equity should be equal to 545 or 500. The way we calculate the expect cash flow, okay, of for levered equity. Okay, we do exactly the same thing of half of what remaining to in case of strong economy. Strong economy is 875 plus half of in case of economy is weak, I have 375. Okay, that give me, and then I divide it by 1 plus R. Okay, I get the value of 543. That looks everything well. So the value of lever equity should go to 543, right? 543 plus the value of debt, the total firm value should be 1043. Professor Martin Miller said it is wrong. Why is wrong? What is wrong here? Anyone see the argument? What's wrong? What's wrong here? You guys follow me? I have 543 compared to 500. Firm value, I have the value of 500 plus 543 compared to 500, which is the value of debt, plus 500. So I compare 1043 with 1000. What do you think? What should be the value of firm? Is 1043 or should be 1000? Do you prefer, what do you think is the right one? 1000. Good. Anyone? You believe the Nobel Prize winner, right? Professor Martin Miller said is 1000. Anyone else? Anyone else? Anyone else? Are you sleeping? Ah, you said it's a nap time. Are you sleeping during my class? Yes? If you're not sleeping, if you don't answer, I'm gonna ask someone to answer. Duke Liam Bui, Duke Liam Bui, are you there? Do you think that it should be 1000 or 1043? Duke Liam Bui say, yes, sir, I think 1000. Very good. Oh, I can call you guys. Good. I can see your guys' name. Sorry for my pronunciation. Hiu Nguyen Nguyen. I have so many Nguyen, but Hiu Nguyen Nguyen. Do you think 1000 or 1043? Hiu Nguyen Nguyen cannot discount on unlevered level. Duc Liêm Bui. Wow, very good. So everybody assume that you believe that it should be 1000. If 1000, if I take the calculation I have made here, something should be wrong here, right? The something that the cash flow, nothing to do it, right? So this is, you pay to the debt holder first. The debt holder borrow as the risk-free interest rate. So they get what is already identified, right? Whereas the equity holders, okay, they expect to get 875 and 375, and then you have the expected cash flow that you can calculate. The only thing that use is about that you use the R to discount levered equity, the same as unlevered equity. So you cannot. Okay, we can prove it. Why you cannot? Because the risk that the levered equity holder take is different than unlevered equity take. Okay, I explain why the risk is different, and then we should use appropriate discount rate to discount the cost of lever equity. Okay, so I remember I read it, the statement of when you got the Nobel Prize, and then some the Nobel Prize winner, they give you kind of a small speech and went to the the conference press, and they explain, and they one of the journalists saying that Professor Martin Miller, would you mind explaining in a very simple word about your capital structure theory that you propose? He said that, okay, let's take the uh, a pizza where you can order small size, large size, XL size, XXL size. Once you make the order of your pizza, okay, the size is given. For example, if you take the he used more on the pie, but let's take the pizza because you may familiar with pizza. The pizza, if you order the large size, okay, once you order, they give you the large size that you order. Now, no matter that you cut into pieces, okay, or you cut bigger part, smaller part, you cut in 4, you cut in 8, you cut in 10 pieces, the size of the pizza is remain intact. It remain unchanged, isn't it? He said that the capital structure theory is exactly like that, right? If you have the project generate cash flow of 1,400 and 900. No matter what happened, okay, either I use debt or levered equity, or debt, or I don't use debt, like in this case, I don't use debt. The value or the cash flow, if you use the same machine, the machine still generate 1,400 and 900. Same for 1,400 and 900. If you order the size of the pizza of the L size, the size of the pizza cannot increase or decrease due to the way you cut the pizza. They said exactly the same thing. All right. So in that case, they're gonna propose that your 1,000, which is the market value of your project or the market value of your firm, should not change. 1,000 should be 1,000. So if the debt market value is 500, so therefore the E should be 1,000 minus 500 is equal to 500. Okay, what you have done is wrong. The calculation that been made here is wrong because leverage increased the risk of the equity of a firm. Therefore, it is inappropriate to discount the cash flow of levered equity at the same discount rate of 15% that we use for unlevered equity. Investors in levered equity require a higher expected return to compensate for its increased risk. Let's prove together what the risks they take. Okay, if I take exactly the same table, everybody follow the first column, 500, 500, 1,000. The second column, the cash flow when strong economy, weak economy, you receive 1,400 in unlevered equity. The cash flow go to 525 to the debt holder, and then 875 go to levered equity holder. When the economy is weak, they go 525, and then 325 go to levered equity. Okay, if I calculate the returns now, when the economy is strong is 5%, right? 525 divided 525 minus 500 divided by 500, I get 5%. When the weak economy, the debt holder will get also 5%. The return when the economy is strong is 75 divided by 500 minus 1 is 75%. Weak economy is 375 minus 500 divided by 500. So you get minus 25%. That makes sense? So you can see the variation of the cash flows. The debt holder is 5% and 5%. So therefore, the expected return is 5%. Whereas the expected return of levered equity, you can see the risk is higher here, right? The fluctuation of return, okay, or standard deviation between the strong economy and weak economy, or the delta of strong and weak, okay, is 75% and minus 25%. So therefore, the risk is higher than unlevered equity where you have 40 and minus 10, isn't it? If you take the delta as a proxy of variation. So if I calculate the expected return of 1/2 of 75, 1/2 of the minus 25, I get 25%. Equity in a firm with debt we call levered equity, E. The value is 500. The RE, which is the expected return of levered equity, should be 25%, not 15%. The levered equity holder increased the risk that the risk to the levered equity holder increase. Therefore, the expected return should increase as well, right? So 15% when you have no debt. If the company choose to have $500 or half of their value with the debt, the levered equity holder will require additional 10% risk premium. So they require right now 25% instead of 15%. So they require additional 10% to compensate the increased risk due to the new debt level of 500 the company decided to carry. All right. So as we can see here, the sensitivity of return, the debt is 0. The unlevered equity is 50%. Levered equity is 100%. Is a proxy of risk here, right? So therefore, the risk premium that we are talking about here, the debt holder doesn't need any additional risk premium because the debt is risk-free. Unlevered equity, they require 10%. Levered equity, in this case, they require 20%. Okay, on the risk premium, okay, 10% more than as compared to the time when the company financed everything by equity. All right, so far so good. Would you mind taking a piece of paper with you? Can you pick up a piece of paper near you? Would you mind filling up this table for me, please? Exactly what we are doing here. But now, what happens if I decide to use only 200 of that? Okay, I have 200 here. And then you filled up this table exactly the same when I introduced 500 debt. Okay, would you mind replicate the table when now if you borrow only 200 before I give you the answer? You follow me? Can you bring your piece of paper and do exactly of what we have done earlier? Piece of paper with you, please. Write the table. I give you 5 minutes. In your slide, you don't have the answer of this table, right? Do you have piece of paper with you? No, we don't have answer yet. Perfect. That's why I want you to do it now. You just draw exactly what we are doing here, right? You have debt, you have levered equity, and then you have unlevered equity. Okay? And then you have debt 0. Instead of using 500, now you use 200. And then unlevered equity is 1,000. The first column is okay. The first column is okay. I give you 5 minutes. And then you tell me what should be the value of the E, what it should be the RE. What should be the RE? If the debt is 200. I give 1 bonus point. Oops, that is not RE, that is the E. E is 800. And RE is equal to what, right? RE is a equity cost of capital or cost of equity capital for levered equity. I noted down your name. If you have a right answer, the first one who give me the answer, you get bonus point. Can be 0.2%, 0.25 or half point. I will decide later on, but I give you bonus point. Aha. If the debt is 200, I give you a hint. Oops, doctor. So the RE should be the RE should be between no, sorry, I have just only oops, a typo here. Right? So when you have zero debt, it is 15%. When you have debt 500, you have 25%. So if you have only 200, the value should go to 17.5%. Wow, I note it down. Huh? I give bonus point to Chu Kian Tan. Very good. I have Quark Dong Fun. Quark Dong Fun, you get 18% or 17.5. You round it up? Yes, okay. Okay, I give you bonus point as well. I have, you have already both. Okay, you're the same person. Perfect. Two of you got the bonus point. Yeah, very good. Okay, so now let's show other people who were sleeping. No, you're not sleeping. Okay, let's go to if the if the D is 200. Okay, let's go one by one, step by step. If I have 200 of debt, I have unlevered. So the last line here, everybody can write it, right? Nothing changed on 1,000, 100, 400, 900. The expected return is the expected cash flow is 1,000, and then you have 40% minus 10, and then you have 15% expected return. Okay, 200 when the economy is strong. Okay, the debt holder will get 210. Again, they assume the risk-free rate. Do you think that this makes sense to assume risk-free rate? It's possible to assume that the debt interest rate for the debt is 5%, or the cost of debt is 5%. Is this good assumption? Can we assume this? Can we assume risk-free? Yes or not? The probability of default, okay, when you told the probability of default, you go to the weak economy, right? The worst case scenario, the company or the project will generate the cash flow of 900. The 900 is go far beyond the 200 plus the interest rate, right? So therefore, we can assume that the debt holder will refi only the risk-free rate because the probability of default is 0. Right? In the first scenario, the company will generate 900, the company should be able to pay the debt plus the interest. So we can assume that the project can get financing with the 5% cost of debt. When the 5% cost of debt here, as you can see here, the lever equity holder will get 1,400 minus 210. Okay, you get 1,190. The weak economy, the 900 will go first to 210 to the debt holder, and remaining cash flow go to 690. And I can calculate the return of when the strong economy, I get 48.75% and minus 13.75%. So my expected return should be 17.5%. This is come from your textbook. Instead of writing and explaining you like this solution, okay, at the bottom of this slide, you can use this table and fill it up easily. Okay, so the levered equity holder bear different risks based on different level of debt that the company decided to carry, to hold. Okay, so to conclude, the Modi-Miller proposition, okay, actually is exactly what we are doing here, okay, but he proposed that the proposition number 1 in the perfect capital. By the way, I saw your question. Somebody asked me a question. What is the question? Oops, somebody asked me the question, what is a perfect capital market? Okay, maybe you didn't come at the beginning of the class. I don't know. Okay, perfect capital market is here. The security are fairly priced. The capital market where is no tax and transaction costs. There is no investment. The investment cash flow are independent of the financing choices. This is definition of the perfect capital market. Okay, in the perfect capital market, actually, Professor Modi-Miller proposed that a total value of the firm is equal to the market value of total cash flow generated by its asset, is not affected by its choice of capital structure. It says that the A is equal to U. Remember, what is the U? U is unlevered equity. The total value of assets should be equal to unlevered equity value equal to debt plus E. E is the levered equity value. All right. So again, some definition of perfect capital market are provided here. That is a proposition number 1. Okay, that explain you the theory of pizza. Right, the pizza is 1,000. 1,000 should be equal to 100 plus 800. Okay, that is a proposition number 1. The proposition number 2, okay, is exactly what you have done in the table. But he proposed, they proposed, not he, because both of them, that the cost of capital of levered equity is equal to the cost of capital of unlevered equity. It means RE equal to the RU plus the premium. And the premium that comes from the debt should be calculated as the D over E multiplied by RU minus RD. Actually, this formula is just simply come from your WACC calculation. RU is our WACC. Okay, so in other words, you can calculate the additional excess return the investor will require due to the leverage, where you can calculate this premium as D over E multiplied by the RU minus RD. Instead of using exactly the table, I can calculate, if you remember one more time, if I have 500 of debt, my 500 of E multiplied by the RU, which is 15%, RD is 5%, I gonna get RE equal to 25% directly without having table. Again, remember, if we borrow 200, if I borrow 200, I can use proposition number 2 to calculate my cost of capital of levered equity. Okay, so I have RU plus D over E. D over E multiplied by RU minus RD, I get 17.5%. If I have zero debt, my RE should be equal to RU, which is 15%. All right, this is a kind of Monty-Miller's is so important that I'm gonna check your understanding tomorrow by giving you some example, okay, and explain what you and how much you understand Monty-Miller proposition number 1 and proposition number 2. All right, so before we go, do you have any question? Tomorrow I'm gonna give you some bonus point. Today I give to Trong Kian Tran and Kwok Dong Fan. Tomorrow I can still have some bonus point for some other questions. Do you have any question here? No bonus point. Any question? I see now almost the end of the session today. Everybody here, right? Beginning, I don't have 49 or 50 people. Now I have almost everyone. No, professor, thank you and see you tomorrow. To Tiando, like, okay, bye-bye. I need to go now. All right. So if you don't have question or you have questions, feel free to ask me tomorrow. Okay. So I have a short homework for you. What the homework we can have? First, if you have time, would you mind helping me to calculate some beta with some Vietnamese stock? Okay. For the problem set, that is the first homework. If you have time, please do so. And then you can go for question number 10 if you have time. Question number 11 you can do as well. Okay, 10 and 11 if you have time. If you don't have time, you can wait and then I tell you the solution tomorrow. Do you have time? Yeah, you don't. So you can wait my solution. Okay, so feel free to do it, okay, this evening or tomorrow morning to estimate beta and then do some question number 9 and number 10, I guess. I forgot already. Oops, yeah, 9 and 10, you should be able, oh no, 10 and 11, sorry. You should be able to do so. All right. Thank you very much for your attention and enjoy your late afternoon in Vietnam. I will enjoy afternoon in Paris since today is very nice weather. Okay, have a nice evening for you. Have a nice afternoon for me. All right, see you tomorrow. I have some bonus points to give you tomorrow, okay? For the people who want to be bonus, okay? See you tomorrow, bye-bye. Au revoir. Tong Hien Tan, you speak French. Au revoir. À très bientôt. À demain. Okay? Demain means see you tomorrow.